Hello and welcome guys, and welcome to this short vlog. And yes, I have always talked about the 80-20 rule, which is applicable for all the professional examinations, be it CA, CS, CMA or whatever. 80-20 rule is always applicable. Now, so what is this 80-20 rule? 80-20 rule means that out of 100 marks paper, 80 marks paper, approximately 80 marks paper will be absolutely following the past pattern which have come in the examination in the past, the kind of questions which have repeated in the past, the kind of chapters that have been asked in the past. So almost 80%, 70 to 80% paper will be aligned with the past a trend which has been followed by the institute for a very long time, right? However, 20% or 20 marks out of 100 marks, questions worth 20 marks will be a little bit kind of a googly questions. What do you mean by that? It means that those questions will not follow the pattern which has been followed by the institute in the past. Those questions might not be from the study mat of the institute. Those questions might not be the regular questions which have been coming in for that particular topic. So those 20 marks are deliberately given by all the professional institute to test your endurance power, to test your patience, because you'll panic, and for getting those 20 marks you'll put 80 marks also at stake. That is the precise reason why those 20 marks of googly questions are always given by the institute in almost all the papers. Usually this is the trend, right? Now, sir, 80 marks is, ideally we should target 80 marks, and out of 80 we should score 50, 60 or whatever. But sir, what is the key to getting those 20 marks also? If you want to prepare for those 20 marks also. So guys, if you want to prepare for those 20 marks also, then there are certain sources which the institute releases for giving you hints that what are the probable questions that it can give in those 20 marks, which will be googly questions, or which will be questions which will be out of the pattern, which will not follow the usual trend which has been followed over past several years. So yes guys, Institute of Cost Accountants of India have released one such indication or one such document that can give you some insight into what kind of questions can be asked in those 20 marks of googly questions. Yes, Workbook has been released by the Institute of Cost Accountants of India for intermediate and final students. And this workbook will really be a game changer for all the students. If you do this workbook properly, then you might expect, okay, see, nothing is certain. Don't say that, oh, Nikkhil sir is trying to predict the question paper, or he's trying to suggest something, he's trying to hint something. No, nothing of that sort. But my endeavor, or all of the faculties who are teaching CMA students, their endeavor is to leave no stone unturned. We have to follow absolute 100% vigilance over what institute is giving us. So yes guys, in this particular session we are going to discuss the workbook which has been released by the Institute of Cost Accountants of India. And yes, this workbook has some path breaking, some out of the trend questions, some out of the trend concepts which have not been dealt with in the regular study mat of the Institute of Cost Accountants of India, and they are given over here. So yes, if you do these workbooks properly, then probably 5, 6 or 7 marks question can be there in the examination from these workbook. So yes, in this particular video, we are going to discuss workbook for CMA Final for Cost and Management Audit. Yes, a seemingly easy subject where scoring 80 is not a big deal at all. You can easily score 80 in Cost and Management Audit. The study material is really limited to the 4 corners of the study material, and all the questions which are there in the study material, past examination question, revolve around the study material itself. So yes, it will be an add-on. If you do this particular workbook also, then it will definitely escalate your marks to the next level. I mean, I can vouch for it, or I can predict that, at least 5 extra marks you can get if you do the workbook properly. So in this particular session, I am going to discuss the entire workbook. No, I'm not going to solve each and every question, but I'm going to pick up those questions where there are some different adjustments which are little not typical, which is not a particular trend which has been followed, and the questions which are typical questions, I'll get you mark those questions, and those questions will be done by you, and you have to do all the questions. In fact, not only those questions, but all the questions after watching this video you have to do in your register without seeing the answers. Answers are also over there, but we are going to discuss the answers and the questions threadbare, especially those concepts, especially those questions which are atypical, which are not typically asked in the past examination questions. Okay, sir. Let's start the workbook of cost and management audit. The PDF you can get on the website of the Institute of Cost Accountants of India. You visit the students page on the home page, and then you click on syllabus 2022. Then you click on workbook. You will get this workbook on the institute's website. I'll put this workbook in the description box also. So cost and management audit paper number 17 of your syllabus, and we are going to start with the first chapter, which is Companies Cost Records and Audit Rules 2014 as amended till 2019. All right. Okay. So first of all, dealing with illustration number 1 to 7. Illustration number 1 to 7 is logic based question which is given in the workbook, which is just asking you simple logics on why is repair and maintenance cost increasing for a particular company. So first question to 7th question, they have given you particular scenarios like repair maintenance cost has increased, security expenses have increased, salary expense have increased, capacity utilization has reduced. What can be the probable reasons for such increase or reduction in capacity utilization? And very logic based question, okay, nothing to mug it up, okay. So if security expenses are increasing from 400 to 500, what can be the probable reasons for it, okay. So probable reasons can be normal inflation. Due to inflationary effect of the economy, the expense has increased. So it's a very routine reason. Then we are increasing scope of our security personnel. So we have another project which is running in, or we have another factory which has been established in the current year, or some kind of additional facility which has been introduced in our business, and that's why over there the security personnel are deputed. Therefore, there is an increase in cost. Substantial expansion in the existing plant, commissioning of new project has been commissioned, okay. Plant which are under commissioning, security cost therefore should have been charged to the project cost, have been charged to the relevant GL of the P&L account. So when new project is under construction, then you have additional security. So it is suggested that those security expenses which are incurred while developing the project, they should be capitalized with the cost of the project. That is what is being suggested. Now the moot point of consideration over here is there is no fixed answer for these questions. Your answer can be very different from my answer. Reason for increase in a particular expense can be explained in several ways. So what you have to do is, for illustration number 1 to 7, just read the probable suggestions, and if you think about some additional suggestions, you can put it on your own way. So it's absolutely up to you. So these are the repair expenses. So increase in repair expenses is there. What is the reason for it? Maybe new machinery has been installed, or maybe the existing machinery has been working overtime or beyond the hours which are expected out of it, or whatever can be the reason. Okay. So illustration number 1 to 7, just read these reasons, and if you have your own reason, if you have some reason which you think is relevant for this particular expense, you can put it out. That's absolutely up to you. So illustration number 1 to 7. 7th is the employee cost. Employee cost has increased during the year. What is the reason of increase in employee cost? Very logical based question, no concept involved, simple logic to be given by you. Okay, sir. So reading this is more than enough. Now we come on to illustration number 8, which is a typical question of profit reconciliation statement, and almost certain that 8 marks profit reconciliation statement will definitely be there in your examination. So very typical question, but very atypical adjustments. A few adjustments in this particular question are different from the usual adjustments. So that is why I want to discuss this particular question in depth with all of you. Please take note of this particular question. It's really different. The adjustments are different from the usual adjustments which we have been doing in our book or in the past examination questions. Alright, so it says that following data are available for a company A. Please prepare reconciliation statement. Profit as per cost records is given to you. Okay. So costing profit is given in this particular question. Usually we have financial profit which is given, but in this one costing profit is given. Then certain adjustments are there. Demurrage for raw material. Demurrage charges have been paid for raw material. Previous year debit note included in raw material cost. Previous year settlement paid during the year and booked in the employee cost. Interest for delayed payment of provident fund booked in the current year as employee cost. Insurance claim received of the previous year. You have to find the financial profit. The ask is to find the financial profit. Okay. Now, all these adjustments are little different from what have been we have been doing in the class or what have been coming in the past examination question paper. So let's discuss each and every adjustment in detail. Okay, I start with the costing profit. Okay, costing profit is 100 crores. Now next is demurrage charges for raw material have been paid. Now as per the financial accounts, demurrage charges are reduced while calculating profit. As per cost accounts, demurrage charges are not reduced as per the costing rules, right? So we have started with costing records. So to reach to the financial records, financial profit, we need to reduce the demurrage charges. So demurrage charges are to be reduced from the costing records to reach to the financial records. So the first adjustment is we have reduced the demurrage cost. Demurrage cost is to be reduced. Okay, next. A debit note, previous year debit note has been included in the raw material cost. Debit note means that we are increasing our raw material cost. Debit note means additional raw material cost has been incurred. Okay, but the moot point of consideration over here is it's previous year, it's prior period expense, it's not the current period expense, it's a prior period expense. So if it's a prior period expense, then undoubtedly guys, this should not appear in the financial records. In financial records, this doesn't form a place. In financial records, prior period expense is never taken. Now, if the previous year's debit note is included in my raw material cost, then that's a problem for me because it's a previous year, prior period expenditure. And therefore, while calculating my financial profit, I'm going to reduce this previous year debit note from my raw material cost to compute only the current year's raw material cost. So what are we going to do? We are going to reduce the debit note of previous year. 3 crore rupees is reduce it to get the financial records. Next, previous year settlement paid during the year booked in the employee cost. Again, same adjustment. There's a prior period expense in the financial records. Prior period expenses are never entertained. So again, the same treatment. We are going to reduce this employee cost from the costing profit. And of course, guys, it is a given that it is assumed that in this 100 crores. All these expenses have already been adjusted. It's a given that. Okay. All right, sir. Next, interest for delayed payment of provident fund booked in the current year as employee cost. Now we have booked the delayed payment in provident fund, delayed payment of provident fund. This is actually an interest which is paid for delayed payment of provident fund. We have booked it in our current year's employee cost. Employee cost is increased by this particular amount, this particular interest which is on delayed payment of provident fund which is booked in the current year. Now this interest, again, as per the financial records, they have to be reduced while calculating the financial record. Interest on delayed deposits of provident fund, for computing the financial profit, we are going to reduce this particular interest. So we have reduced this in our while calculating our financial records. Next is insurance claim received for previous year. So insurance claim has been received of previous year. Previous insurance claim is there, and this was received in the current year. So when this is received in the current year, this is actually in the nature of income. This is an income which has been received in the current year, and this income has to be added in our costing profit, because costing profit will not have this income, because costing profit is only income which is resulting from operations of a particular business. Whatever sales are there, whatever income is from the sales, that income is added in the costing profit. So costing profit would not have this element in it. However, financial profit will definitely have an element of insurance claim which is received. So we're going to add insurance claim to our costing profit to get the financial profit. So simple as that. The income which is received as per the insurance claim settlement, that income is to be recognized as per the financial records. It is not recognized as per the costing records. Our costing records, our costing profit will be devoid of such income. Okay, so we are adding this income to our costing profit to get our financial profit. So yes, all these adjustments are little typical. So you need to really remember these adjustments and apply logic and come to an answer, so that if in the examination, next examination, this adjustment comes, then you're able to solve it well. Okay, sir, got it. Next, inventory of raw material. We have to find inventory of raw material. Inventory of raw material is to be found using the data which is given in illustration number 9. Now, inventory of raw material, following data is made available from costing records of company A. Inventory of raw material 7,300. Consumption of raw material 94,000. This is amount in lakhs. Consumption of raw material per day. Per day consumption is 94,000 divided by 360 days. 360 days is the days which are assumed for a particular year. So per day consumption is 261 lakhs. We are maintaining inventory of 7,300 lakhs for a per day consumption of 261 lakhs. So inventory is consumed 261 lakhs for one day, and 7,300 is the total consumption of inventory which is taking place in the entire year. Now the point is that for how many days of inventory are we storing in our godowns? So 28 days of inventory we are storing in our godown at any given point in time. 7,300 divided by 261. One day consumption 261. 7,300 is the total inventory which is there. So 28 days of requirement is stored in our warehouse. That is the question giving us. Management has desired to reduce this inventory level to 20 days for the requirement. So instead of carrying so much of inventory, because it comes with a cost, we are going to reduce the inventory which we are carrying in our books of accounts and our warehouse, our godown. So 20 days worth of inventory is to be stored. Nothing more than 20 days inventory level is required to be stored in our godown. A cost auditor, please advise the management steps to be taken. Okay. So what are we going to do to reduce the inventory level? That is the ask. Okay. We have to reduce the inventory level from 28 days to 20 days. What are the 3 steps that we are going to take? So these are the broad 3 steps which we can take to reduce our inventory levels. We have to reduce the carrying cost of inventory. Therefore, we have to reduce the inventory carrying value. So reducing the lead time between purchase order and delivery of material. So when we are purchasing the goods, when we are purchasing the raw material, and when it is being reached to us, when it is being delivered to us, we have to reduce that time. Because if that time is reduced, then we can make quick purchases. If we can make quick purchases, then the need for maintaining high level of inventory will not be there. So we have to reduce the time between purchase order and delivery of material. If we have to change our vendor, we can change our vendor also. We want a vendor who can promptly give us the inventory as and when required, rather than storing so much of inventory with us. Okay. Next, reducing the material content. So, whatever material we require for our production, if that material requirement is huge, we can reduce it by doing some research and development on inputs which are less required for the production process. So, for example, if I'm making this pen, it's made of plastic. Okay. I'm using, say, 2 kgs of plastic to get 1.5 kgs of finished products. I need some plastic, some processing changes or some raw material changes that can reduce this 2:1.5, that can reduce it to 1.8:1.5. So if we reduce the level of input output ratio, if input is reduced and output is increased, then level of inventory that we require to store will also be reduced. So reducing the material content through research and development, we can reduce, or we can have new vendors who can offer a superior quality of raw material, so that large output is produced with limited inventory. Finally, reducing the procurement price. If we are able to reduce the procurement price, then automatically our inventory carrying level in terms of rupees will reduce. So if we get cheaper input, that will be preferable to us. Okay. So yes, guys, if you see these questions, they are more logic based. But when you are in an exam like situation, your brain will not work. It will not work accurately. Therefore, if you read through these points thrice, your brain will work at the time of examination. That's the precise reason why I'm making this particular video on this workbook. Okay, sir, got it? Illustration number 10, raw material inventory. What can we do in case of raw material inventory? And in this particular question, guys, the ask is, or the main thing is that whatever we have studied in our last question, okay, this inventory carrying, these steps of inventory carrying. So what is the inventory in terms of number of days? 20 days inventory is being carried by us. Okay, we have made this computation. The next question is just providing you a format on how to present this inventory carrying level. That's it. There's no other specific point in illustration number 10. So illustration 10 gives us a format where we can prepare our level of inventories, how much inventory is in our warehouse, go down, and how much is required per day. So how many days of inventory is kept with us, and how can we reduce it to a level where inventory carrying cost is reduced. So this is just a format, nothing new in illustration number 10. But you have to read it, okay? I am just explaining you and just going to the next question, but this is not what you have to do. You have to read it properly, okay? And even illustration number 1 to 7, you have to read it, guys. Please read it religiously. Please read it carefully. All right, illustration number 11, format of CRA3. In this particular illustration, we are just discussing the format. We are just having the format of illustration number of CRA3. Form CRA3 tells us it is an annexure to the audit report. The annexure to the audit report contain part A, B, C, D that we have discussed in great detail in our class, right? I've told you in the class also, I'm telling you now also, guys. Part A, these 4 points you should remember. Part B, these 4 points you should remember. What the contents of the annexures, you have to remember them. They are important from an MCQ standpoint. They are important from an independent question standpoint also. You have to remember these details which are disclosed in part B. You have to remember these details which are disclosed in part D. Okay, and these are practical things that we do in the class. So these you will automatically be able to remember. So this question deals with only the format which is there in CRA3 and what are the important questions, or what are the important points that are to be disclosed in form CRA3. That's it. This is what is disclosed over here. So you must be wondering, what am I flipping? I am flipping the exact workbook. I have the exact workbook, and before starting this session I had gone through the workbook and I have noted down certain important points in every question that need discussion, and therefore I am referring to those discussion points. Okay, sir. Illustration number 12, output cost centers. Now this particular question is giving you an insight into certain cost centers and how the cost center cost is to be either reduced or increased. The inventory levels are to be adjusted according to the cost center level. Okay, let me read this question. Let us go through this question. To enable build-up of cost records, you as a cost auditor has been advised output of the following cost centers. Diesel generating set, okay, DG set is there. Boiler is there, air compressor is there. So what is the output of these equipments? So obviously DG set will produce electricity, boiler will produce steam, and air compressor will produce instrument air. Instrument air means an air which is more like or more required in the production process. Like we have air which is devoid of water. Humidity will not be there in that air, so that the environment remains protected, the product remains protected. Okay. So these are the equipments, and these are the outputs. Now illustration number 13 is a very, very interesting illustration and a very simple thing, which has been demonstrated in illustration number 13. But I am very sure if this question comes in the examination, at that point in time, due to pressure, your brain will not work. So a very typical point, a very different point, but a very, very easy point. Let's go through illustration number 13. Following data are available for inventory of raw material A. Raw material A inventory is given to you. Inventory 100 metric ton. 1 month old, purity is 100%, revised purity is 100%, original value of this product was 1 lakh rupees. Then 2 months old, so this inventory is 2 months old, 100% purity is there, but when we did a revised purity check, purity has reduced, it's 95% in the revised purity check, and the original value was 90,000 rupees. So these 100 metric ton of raw material was purchased for 90,000 rupees. 3 months old, raw material is also there. Same raw material is there, but their purity has changed over the period of time. Purity has changed means, they have developed something which has reduced their efficiency. Their efficiency has reduced. Okay. So 3 months old, its efficiency is only 90%. And it was purchased for 80,000 rupees. So this is the inventory which we are carrying. 1 lakh rupees, 90,000 rupees, 80,000 rupees. Original value of inventory is 2,70,000 rupees. Now the question which is asked to you is, please calculate the value of inventory of raw material which is to be put in the cost records and cost audit. What value should be put in our cost records and cost audit? Now obviously guys, the value which is actual value of the inventory is to be put in our cost records and not the original value, which means that if this inventory was purchased for 90,000 2 months back, but now its value is not 90,000 for us. Today its value is only 90,000 multiplied by 95% for us. Its value has reduced for us because its utility has reduced, its efficiency has reduced. Therefore, current value of this particular part of inventory is 90,000 multiplied by 95%. The first part has got 100% purity, no problems in that. We are going to take it at the full level. 80,000 value, but its purity is 90%. So 80,000 multiplied by 90% is the value as on today of this particular inventory. Okay, so this is how we are going to calculate the revised value of inventory, and we are going to come at the revised value of inventory level at the end of the year. So this is how we are going to do this question. So a very simple question, okay, a very logical based question, but this happens, guys. When you are sitting in that I would say gas chamber, which is the examination hall, your brain automatically starts, under panic situation, it starts working less. So very simple question like this, you will not be able to understand. That is why this workbook is so important. That is why doing this workbook is so important, okay. So case study is very simple. The CRA 3 has been discussed in this particular case study. MCQs are given. Please go through the MCQs. I've already gone through the MCQs. Pretty straightforward. From the entire syllabus, these MCQs have been asked. So no need to discuss them over here, okay. But you have to go through these MCQs by yourself for sure and revise it also, okay. Okay, so let us come on to the module 2 of this particular workbook, which relates to of course, the most important topic of your syllabus, cost accounting standards. Cost accounting standards is definitely commanding at least 20 marks in your examination, right? 20 marks will come from cost accounting standards, especially from cost accounting standard 1 to 10. They are the most important. Okay, now let us see the questions which are given in the workbook, and let us see what is the unique points that we need to follow in this particular cost accounting standards. Okay, so first of all we have, okay, this CAS 10 illustration number 1. This is just a format which is being explained over here. The ask is that which cost component are relevant for cost sheet for production on job work basis. So whatever job worker does, what kind of a cost sheet can you expect of a job work? This is the kind of cost sheet that job worker will have. Job worker will have these kind of expenditure: raw material, utilities, electricity, steam, raw water, filtered water, demineralized water, cooling water. So these are all the things that job worker will typically have in its cost sheet. Okay, so this is just a format. You have to just read this format, understand this format, and that's all. That's it. All right, very important part of our cost accounting standards, foreign exchange difference. As you are aware, the entire transaction or commercial transaction of sale or purchase will undergo at various dates. Now, if you're dealing with a foreign client, you are selling your goods to a foreign client, you are selling your goods to United States of America or Australia, then at different points in time, you have different foreign exchange rate. Which forex rate to be taken for recognizing in your books of accounts, in your Indian books of accounts, because INR is to be is the relevant monetary value which is required to be registered in the Indian books of accounts. So which foreign exchange to be taken? Is it the payment date foreign exchange, or the date when the agreement has been signed between the two parties, or the payment when goods have been delivered? What should be the date? The date should be the transaction date. Transaction date means date when all material risks and rewards have been transferred to the other party, which means delivery. In case of goods, it's linked to delivery. Okay, so for that particular concept, we have this particular question. Foreign exchange difference between date of payment and date of transaction. Quantity imported 100 metric ton, purchase price $100, exchange rate on the date of GRV. GRV means goods received voucher. It's just like GRN, goods receipt note, goods receipt voucher. Okay, so either this should be the rate at which the transaction is to be recognized in the books of accounts, or the date of receipt of invoice when the invoice was received, or date of payment. Of course, the relevant date will be the date when the goods have actually been received. So $80 per rupee, 80 rupees per dollar is the relevant rate that we are going to take in our books of accounts. Now the question is, sir, payment will be done at 84 rupees. So what are we going to do with that additional 4 rupees of expense which are there in our books of accounts? What are we going to do that? Because 4 multiplied by 100, 4,000 rupees is the additional expense that we are going to have in our books of accounts. What are we going to do with that? That will be debited to our forex loss account. It's a separate account which will ultimately be charged to your overheads. It will be an overhead for you. Okay, so that is what is the treatment. So the booking should be done at this rate: 100 metric ton multiplied by $100 multiplied by $80, and the exchange difference, which is 40,000 rupees, the exchange difference is to be treated as overheads. It will be debited to the forex loss account. Okay, sir, got it. Illustration number 3 is a very simple matching the two sides. Cost accounting standards are given at one side, name are given at the other side, and you just have to match it. So a no big deal at all. Illustration number 4. Again, illustration number 4 tells you some data from the trial balances given to you, and you have to identify which cost accounting standard would that expense be related to. A very simple question: raw material, basic salary, DA, depreciation. Which cost accounting standard will all these expenses be related to? And it's a very straightforward and simple question. You just have to mention the cost accounting standard. And I hope that you remember all the cost accounting standards at least by their names. All the 24 cost accounting standards should be on your tips by their names. Names should be remembered for sure. Whether it's MCQ question or whether it's a cost accounting standard theory question, name will be very, very relevant to you. So name should be on your tips. Okay, sir, got it. All right, now we come on to cost accounting standard 2, which is capacity determination. All right, and this is definitely an important cost accounting standard, and the questions which are given in this particular cost accounting standards are definitely important. All right, illustration number 5. Illustration number 5, product A of company B passes through following 3 cost centers. So 3 cost centers are there, and product A passes through 3 processes. So 3 processes are there in which product A is made before it emerges as a finished product. So process D has got capacity of 100, process E has got capacity of 90, and process F will have capacity of 85 metric ton. As a cost auditor, you are asked to work out the installed capacity of the product for the cost audit report CRA3 part B. Now the more point of consideration is that there are 3 processes, and 3 processes have got different capacities. Which one to take? Ideally, the capacity is to be taken for the factory as a whole and not the process, not the individual process, guys. The capacity is to be taken for factory as a whole, for the entire process as a whole, for the unit as a whole, the capacity is required to be taken. Now the unit has 3 processes, and all the 3 processes have different capacities. Which one is to be taken? That is the question that we are deliberating over here. So in this particular case, always the limiting factor is to be the capacity, which means that suppose process D manufactures 100 metric ton of material, but process E manufactures only 90 metric ton. Will it be possible that these 90 metric ton will go through process F? No, because process F can only process 85 metric ton, say, per day. So the limiting factor, on one day, only 85 metric ton of completed product can be produced. Yes, partly completed product can be there. Partly complete means process D completed can be there. Process E completed can be 90 metric ton, but the complete finished goods, complete product will only be 85 metric ton. And therefore, the installed capacity for the entire factory is 85 metric ton. Because this is the maximum that we can produce in a particular day. Because process F will not allow us to produce anything more than this. So very important point to be noted over here, that limiting factor is the capacity that is to be taken as the installed capacity. So installed capacity is the limiting factor. Okay, sir, got it. Now I have to read this entire explanation and of course underline the important words like the limiting factor shall be considered as the installed capacity. That's how you have to really understand it. Okay, sir, got it. Illustration number 6. Again, illustration number 6 is a pure theoretical question where cost is given to you and you have to just know what kind of cost, what number of cost accounting standard will be eligible for it. So it's a straightforward question. Illustration number 7, an interesting question. Illustration number 7 says that data has been given to you of a company. Data is given for a company X for raw material Y. As cost auditor, please advise cost component to be considered for cost records for raw material as per CAS 6. So as per CAS 6, you have to find the material cost. Material cost is required to be ascertained by you. Material cost is required to be ascertained by you. Now raw material cost is given to you 70 lakhs, and of course this raw material cost would be the raw material cost which is appearing in the financial records, right? Because the raw material cost as per costing records has to be computed by us. So as per financial records, this cost would have been there. 70 lakhs. Utilities cost is also given 20 lakhs. Fixed cost is given 10 lakhs. Moreover, it is further provided that raw material cost inter alia consists of the following. So raw material cost has got 2 debit notes in it, one for the current year and one for the previous year. Previous year debit note is there, current year debit note is also there. Okay. Then we have credit note of current year and credit note of previous year. Credit note of previous year is also there, credit note of current year is also there. And of course, we are not going to include any prior period expenditure in our current year's financial statements. So it says that debit note of previous year is included in our raw material cost and credit note of previous year is included in our raw material cost. Both of them are included in our raw material cost, which is given as per the financial records. And of course, while calculating the cost records, we are not going to include any prior period expense in our current year's cost records. So therefore, we are going to reverse effect of this debit note of previous year and credit note of previous year. So we are going to reduce this. Debit note means expense has been increased. So I'm going to reduce this expense of previous year from the current year's raw material cost, and credit note means the expense has been reduced. So I'm going to add the previous year's raw material cost, because that is not required to be included in the current year's financial statements or the costing statements. So I've reversed these two elements while calculating my raw material cost. So raw material cost, revised raw material cost is computed as 64, which is as per the cost accounting standards. We are going to put it in our costing records. Okay, sir, got it. Next is illustration number 8 related to utilities. And yes, utilities are costs which are to be infused while calculating our direct expenses. And let's read the question. Illustration number 8. Company A has procured electricity from 3 sources during the year. State board 75 lakh units, rate is 6, 450 lakhs. Then private player, we have 50 lakh units, 5.5, 275 lakhs. Then we have own power generating plant, 200 lakhs, 4 rupees, 800. So the weighted average is calculated as 4.69, and please note that this weighted average is the key. This is the most important relevant factor to charge our electricity cost in our cost sheet. And we've already done this kind of a question in our class also, guys. Okay. So this is the weighted average 4.69. Total units which are supplied of electricity are 325 lakhs, and the total cost is 1525 lakhs, and the per unit cost is 4.69 per unit. Company is manufacturing 3 products. So 3 products are being manufactured, X, Y and Z. Electricity consumed by all 3 products are mentioned below. So 200 lakh kilowatt hour has been consumed by product X. 75 lakhs kilowatt hour have been consumed by product Y, and 50 lakhs kilowatt hour have been consumed by product Z. So product all the 3 products have been consuming this cost of electricity. Okay. Now at what rate? The question is at what rate the electricity cost appears in the product cost sheet of X, Y and Z. What is the rate at which it should appear? Now deliberately to confuse you, question has given exactly the same numbers which are corresponding to the procurement numbers. 750, 750, 50, 50, just to confuse you. But please note that whatever sources are being used to procure the electricity, we are using it in a consolidated manner to produce our 3 products. So weighted average rate is to be used in the cost sheet of the respective products. That is the point. 4.69 kilowatt hour. Weighted average is to be used for charging our electricity cost to the respective product cost center units. Okay. So product X, this much units, this rate, this is the price. Product Y, product Z, total price and total allocation which is there. Okay. So yes, a very basic point, but sometimes doesn't get really registered, doesn't get triggered when these questions come in the examination. Next is illustration number 9, utilities cost. Again, a similar kind of a question where again weighted average will be the relevant rate of electricity charging in the cost sheet. Following data are given in respect to electricity units and value. Cost auditor, please advise management how electricity cost shall be worked out in accordance with CAS 8. Electricity purchased from state board, rate has been given. From private sector, from own power plant, from windmill, the cost is given. Now from windmill means you have windmills where the electricity is being flowing inside your factory, maybe your windmill or someone else's windmill, doesn't matter. And on this particular case, cost of electricity is given to you as this, and the credit for electricity. Credit for electricity means these are some benefits that are being given to you by Government of India for using renewable energy. So whatever whatever electricity you use, you get some benefits out of it, some credit which can be given to you by either Government of India or any International Monetary Fund, that kind of organization, for environment protection. Okay. So yes, you can very well see that the cost which is incurred in consuming this electricity is 3 rupees per unit, but the benefits that you are getting out of it is 5.5 rupees. So this can be a scenario. Okay. You are getting more benefits for using the renewable sources of energy. Now the ask is, work out the following. Total electricity cost you need to find out, and the average rate of electricity, which again means weighted average price. So total cost, we are going to just multiply each of the units by rate. Okay, these are the total cost. We are going to add the renewable form of energy, and then we are going to reduce the credit which is given to us for the using the renewable source of energy. Okay, so this is the credit, which means reduction in our cost that is given to us. And if we reduce it, we'll get the weighted average cost, we'll get the average cost and the total cost which is used in the electricity. Okay, so this is the kind of simple calculation, very straightforward, very simple calculation, and a very easy kind of a question. So if examiner wants to give these kind of questions in the examination and you've done it once in your lifetime, you'll easily be able to crack it, That is the idea. But please, my advice is that do not just leave this video over here as it is. Just do these questions by yourself once the video is over. So comment in the comment section below that yes sir, we will do these questions by ourselves, or we have done this question by ourselves in writing in our register. Please write this in the comment section below. Illustration number 10. Following data are made available with respect to employee cost of the company. So data is given to you for the employee cost. As a cost auditor, please advise company how to work out the employee cost as per CAS 7. Employee cost as per books of accounts is given to you. Financial books of accounts 100. This includes value of employee settlement of the previous year, okay, prior period expense. Value of interest on penalty for delayed payment of deposit of tax. And of course, guys, both of them will be reduced because as per the costing records, both of them are not to be added in the employee cost. Administrative overhead, CAS 11. Okay. Again, this is a theoretical question, guys. Okay, where what all expenditure will be included in the overhead, administrative overhead expenses, they are to be identified by you. So only two are not administrative overhead, which are donations and corporate social responsibility. So whatever charity is being done, costing records do not recognize that as an expense. It's not an expense, it's not a cost of production according to costing norms. So these are not the administrative overhead. Rest everything is administrative overhead. Okay, sir. Raw material, illustration number 12. Now again, an easy and a straightforward question. Given below data pertaining to raw material consumed in the process. So quantities, rates and values are given to you. Please work out the following as per CAS 6. Raw material quantity that will go to production. Whatever is the raw material quantity which will go to production, which is total of these three. Raw material value that will be charged to production. Total of these will be charged to production. That is a very straightforward and a simple answer. That is how the answer is to be computed. But please compute it yourself also. I'm again and again repeating it. It's an important point. Please, do the answers by yourself also in the register. All right. Again, this is a very direct question, very straightforward question, which the cost accounting standard is applicable for job work charges, shall be shown as a separate line item. So very straightforward and a simple question. Illustration number 13 also. Then we come on to illustration number 14. Illustration number 14 gives us the data related to raw material X, which is used for product A and product B. So used in product A, raw material X is used in raw material A, but there's no recovery which is happening. There's no amount that is sold for the waste. This is the waste amount of raw material, but nothing is recovered from it. Same raw material X is used in B also. Over there, whatever is the waste, recoverable is there. 500 recoverable is there from the waste. Okay, that's the difference between using same raw material in A product A, B product B. Okay, same raw material is being used. Calculate the raw material cost for product A and product B. Naturally, guys, whatever is recoverable from product B, that will be reducing the cost of production of product B. Simple. Nothing will be reducing the cost of production of product A. Simple as that. And that is the treatment which is given over here. Okay, sir. So these, most of the questions are pretty straightforward and pretty easy. Yes, most of them are pretty straightforward and pretty easy. And the questions where there are some technical points, I'll be able to highlight them for all of you, in my discussion. Okay, sir, got it. Yes, illustration number 16. Very, very interesting, very, very nice question, which has been drafted by the institute. Raw material X is supplied by supplier A, B, C. So three suppliers who are supplying same raw material A, B, C. Now, this raw material, one raw material is used for preparing three products D, E and F. Purchased from supplier A gives raw material X at 1000 rupees for 25 per kg. 2000 kgs for 27 per kg and 1500 kgs for 23 per kg. Consumed by product D, E and F respectively. Raw material X is procured by specific vendors and being used in specific products. Doesn't matter to us. For us, raw material cost is one and only, it is to be clubbed together. Okay, it's a combined raw material cost. So the ask is that as per CAS 6, you have to find the value of raw material cost in product D, E and F. What is the value which is charged to D, E and F? That is the question. Now, the value which is charged to D, E and F will be the weighted average price and not the individual price, guys. Please note that this bifurcation is all a facade to just disturb your mind. This bifurcation is absolutely useless for me. I'll find a weighted average by doing the weighted average formula calculation, and then I'll be charging it to respective products. I'll not be charging these amounts which are given over here. So the weighted average is this, and this is what is being charged to product D, E and F. Same as we had seen in electricity. In electricity also we had seen the same weighted average concept which is being used. Same weighted average concept is being used over here also. All right. CAS 2 has returned capacity determination as per CAS 2. Okay. So, okay, now we have illustration number 17. Following data are available with respect to cost elements. Cost elements are given to you. Raw material 70 lakhs, variable cost 10 lakhs, fixed cost 30 lakhs, so total is 110 lakhs. Actual capacity utilization is 50%, 50,000 units is the actual capacity utilization. Normal capacity utilization is last 3 years is 80,000 rupees. So current year there has been a substantially low capacity utilization. Normal capacity utilization was 80%, 80,000 units. This year it has been substantially low. It's only 50,000 units, which is only 50%. Okay, sir. Please work out the fixed cost for cost records as per CAS 2. As per CAS 2, what will be the fixed cost which will be charged, that you need to work out. Alright, so as per CAS 2, the capacity utilization shall be considered as per actual capacity utilization, as the same is significantly less than the normal capacity utilization. So as per CAS 2, we'll consider the actual capacity utilization for calculating our relevant cost. So what is the fixed cost as per the 80% capacity utilization? The fixed cost as per the 80% capacity utilization is 30 lakhs. So this will be reduced. Okay, so 30 lakhs divided by 80,000 multiplied by 50,000. So whatever is the normal capacity utilization, we'll divide by normal capacity utilization and we'll multiply it by actual capacity utilization. Whatever is the under absorption or of overhead, whatever is the under recovery of cost, that is to be taken to the costing P&L account. That is to be taken separately to the profit reconciliation statement also. Okay, so the calculation is that 30 lakhs divided by 80,000, which is the normal capacity, multiplied by 50,000, which is the actual capacity. So 18.75 is the amount which is to be added in the material cost, and the underutilization of capacity, that is to be taken to the profit reconciliation statement. Okay, and we have already discussed this topic in our regular lectures also, guys. So this is a common topic. Okay, sir. Raw material cost is the next. All right, raw material cost is given to us. Okay, and a very straightforward question, guys. We have done these kind of questions in our exam, in our regular study mat also. Raw material which has been purchased is 100 metric ton. Normal evaporation loss. Okay, this is the normal loss, which is 22%, is 20 metric ton. Obviously this is to be absorbed in the rest of the products. Purchase rate 10,000, purchase value 100 lakhs. So what are you going to do is purchase 100 metric ton. Evaporation 980 is the quantity which is available for consumption. Purchase value is 100 lakhs. So we are simply going to divide 100 lakh by 980 metric ton. Simple. This is a normal loss. So normal loss is to be absorbed in the rest of the products. Yes, sir, we remember this concept. Okay. Now we come on to illustration number 19, which relates to the utilities cost. Yes. Okay. Following data are made available with respect to steam. Gross generation of steam 3,50,000 metric ton. Normal line loss 5%. Steam value 9,000 lakhs. At what rate steam shall be charged to the production process? Okay. So steam which is generated is 3,50,000. Normal loss is 5%. Okay. So after deducting 5%, what is the steam which is given to the production center or the production cost center? It is 3,32,500 steam is given to actually to the production cost center. The cost of the steam or the value of the steam is 9,000. So we are simply going to multiply 9,000 by we are going to divide 9,000 by 332,500 and multiply it by 1 lakh units. We are going to simply multiply it by 1 lakh units. Okay, so what we are going to do is we are going to just imbibe the total cost amongst the units which are left after the normal loss. So what is the total cost of steam? Total cost is 9,000 lakhs. So 9,000 multiplied by 1 lakh, we'll get in terms of rupees what is the total steam cost. So total steam cost in terms of rupees, 9,000 multiplied by 1 lakh, divide by 332,500, which is the quantity which is left after the normal loss. This is how we are going to allocate the we are going to charge the electricity cost, steam cost into the product. Okay, 2707. Okay, sir, got it. Let's move on to illustration number 20. Alright, so this is consumables, stores, a very straightforward question, theoretical question. No practical involved. We just have to, you have to identify the cost accounting standard, and I have already told you, you have to remember all 24 cost accounting standards by their names. Remember which cost accounting standard is applicable and how can company comply with their standards and what are the benefits derived while complying with this cost accounting standards. Pure theoretical question that is there. Its answer is absolutely simple. You just read it out, you'll be able to understand it very easily. Same is the case with illustration number 21. I'm not going to discuss in detail a theoretical question that if you just read, you're going to understand it absolutely simply. And still guys, if you're not able to understand any part of it, just comment in the comment section below or just call me up. I'll be able to help you out with that particular part if any part is not clear to you. Okay, so again, depreciation is also theoretical discussion is there in the entire depreciation question. There's no practical involved, and theory discussion is why should we comply with this standard, what are the benefits derived if we comply with this standard. So a very understandable and an easy theoretical straightforward question in front of you. Packaging material cost also, the treatment is to be explained, so a straightforward question again in which treatment is required to be explained in this particular question. Yes, in this particular question, now a very common sense related question, but sometimes what happens is during the examination our common sense also fails. A very common sense question, so please understand the question. The gross pay of an employee is 12 lakhs, TDS which is deducted is 2,40,000. So what goes in the hands of the employee is only 9,60,000. Now the question is, what should be the employee cost? Should it be 12 lakhs or 9,60,000? Of course 12 lakhs. Of course 12 lakhs. Doesn't matter whether you have to pay taxes to the extent of 2,40,000, the gross salary is always the employee cost. So a very straightforward question again over here. But as I always say, sometimes during the examination, straightforward questions seems to be difficult. Sometimes you feel, no. CMA final question paper, this kind of easy question cannot come. No, sir. No, not possible, sir. Not possible. This kind of easy question in CMA final level? No. Yes. It is possible. This kind of easy question can come in your examination. So don't overthink and don't think that there's something which I'm not able to understand in this question. No, nothing of that sort. Okay, illustration number 25. And capacity determination is not leaving our is not leaving us at all, coming back again and again, different forms, guys, which is okay. All right, let's study the next question. The next question is illustration number 25. Company G is making product C. Capacity to manufacture product C is 800 metric ton per day. For the period April to December, product C is manufactured at 800 metric ton per day. From 1st January, company G enhanced the capacity of product C to 1200 metric ton per day. Now please note that during the year there has been a reassessment of capacity, and this concept we have dealt with in great detail in our classes also. I have in our marathon lecture also explained this concept of reassessment. So if in the part of the year, which means middle of the year, the capacity enhances, then we don't take that enhanced capacity for the entire year. We are going to prorate. So for half of the year, the capacity will be the higher capacity. For first half of the year, capacity will be the lower capacity. We prorate. We don't say that, oh, at the end of the year the capacity was this, so for the entire year capacity is this. No, capacity will be prorated. Okay. If you remember, we have done a question in the class related to Rolls-Royce. Yes, this is that concept, Rolls-Royce concept. Okay, sir, let's see the question. During the year, company G has manufactured product C as mentioned below. 30 days, 9 months. 9 months means April to December. Okay, 800 metric ton, which is perfect. Then for the remaining 3 months, the capacity is 1200. They have taken as 1150 per metric ton. Maybe some kind of planned maintenance or something like that, which has happened during the period, but the question doesn't give anything. But let's see what happens. Okay, so this is the total capacity which is given for the entire year in this particular question. Company has given its cost record to the cost auditor, providing the capacity utilization as mentioned below. So the capacity utilization is 360 days for 1200 metric ton per day, 4,32,000, and the capacity utilization is 3,19,500. This is the actual capacity utilization which the company has given. Okay, this divided by this, the company has given you a ratio of 74% is the capacity utilization. Now, what is the ask? The ask is, if you think that something is erroneous in this particular computation, please point out that erroneous point. That is the ask. Okay, sir, got it. So, cost auditor has reworked the installed capacity considering CAS 2. Installed capacity for first to 9th months, first 9 months is 800, capacity for next 3 months is 1200 per metric ton. So the computation will be revised as per this particular computation. Okay, and what is the revised computation? Revised computation is that for 30 days, 9 months, 800 is the capacity. For 30 days, 3 months, 1200 is the capacity. Now that 1150 was not required to be reduced. Now why this reduction of 1150 was there? So first of all, let's compute the actual capacity, the installed capacity. The question has computed the installed capacity as 360 multiplied by 1200 metric ton per day. Considering this 1200 as on the year end capacity as the complete year's capacity, but this is not the complete year's capacity. That's the error which question has done. Installed capacity is not 1200 for the entire year. It is split into 2 parts, 9 months and 3 months. So the installed capacity, which is the correct installed capacity, is this: 30 multiplied by 9 multiplied by 800, 30 multiplied by 3 multiplied by 1200. This is the installed capacity. This is the installed capacity. And yes, the actual capacity, whatever is given in the question, 319,500, we are going to honor it. Okay, this 1150 is actual loss, maybe due to anything, the machinery cannot perform for the entire year practically because of planned maintenance. So there's some maintenance which is required to be done every year. So the machinery installation, at time of installation only it was decided that installed capacity is barring this 50 hours. This 50 metric ton is a planned loss, is a installed capacity loss. This is the actual capacity which has been attained during the year. This is the actual capacity. Okay, so if actual capacity remains the same, we are not going to change the actual capacity. It's 319,500. So 319,500 divided by 3,24,000. 98.61% is the actual capacity utilization. The error which was done in the question was in terms of installed capacity. Installed capacity was not correctly computed in the question. That was the error. Okay, sir, got it. Next is CSR contribution, a very, very important aspect from an exam standpoint also. That guys, CSR contribution is not to be included in the cost. The crux of the matter is that CSR expenses are not to be included in the cost records. That is the crux of the matter. Theoretical question, you can easily go through it and easily read it. Company G obtains electricity for private player. Electricity from private player is taken and value includes payment of 40 crores related to previous year, which was disputed and released in the current year. So just that, for the current year, we are going to take only 560 as the cost, because 40 is the previous year cost and prior period cost we are not going to take in our cost. Okay, sir, got it. Yes, an important question. This is a good question and an important question. Okay, let's study. So during course of audit of cost records, cost auditor has come across the following financial GL. Raw material consumed during trial run. Raw material which is consumed before production starts, before commencement of production. During trial run, the raw material has been consumed. Secondly, raw material consumed for commercial product. This is perfectly fine. But the question is whether raw material cost should include this 100 lakhs or not. During trial run, it was incurred. So guys, strictly speaking, trial run is not a commercial starting of your project or your business. So cost sheet, where raw material cost is concerned, trial run cost is not a cost in the cost sheet. Actually, it should be capitalized with the plant cost, because it's the feasibility study that you're doing using these raw material. So technically you are just trying whether the product will be comfortably made or not. So this should be added to the capitalized cost of your plant. That is the point which is written over here. Okay. So this cost shall be capitalized with the cost of the project. So the only amount which is to be sent to the raw material cost will be 7,000 lakhs, and this amount should be capitalized with the cost of the plant. Yet again, capacity determination, it is the favorite cost accounting standard of all the examiners also. And yes guys, capacity determination is such an important topic, such an important cost accounting standard, that in every alternate attempt you will see one question of capacity determination for sure. Okay, so capacity determination, company G is manufacturing product C, having its byproduct BP, installed capacity to manufacture its 1200 metric ton per day for 350 days. So the installed capacity is 1200 metric ton per day, and 350 days the factory will be running with total 365 days available, and 7 days for planned annual maintenance. Okay, so in the installed capacity also 7 days will be reduced. Okay, these 7 days are planned maintenance days, where the plant will be shut down, plant will be not be working. So the effective days are 358 days only for the machinery. Okay, so now over here please note one very important point. The installed capacity is 358, it's not 365. Please note this point, it's very important. The plant can work at the rate of 1200 per metric ton per day for 358 days. The plant cannot run for 365 days. So the installed capacity is not 365 days. Installed capacity will be calculated using 358 days. Please note this point, it's very important point guys. Whenever the question gives you an information this way, that the plant is going to work for 358 days period, installed capacity is to be computed using 358 days and not 365 days. Please note this point. 365 days has been deliberately given to you so that you get confused, and while calculating the installed capacity you use 365 days as the number of days. Please don't do that. Okay sir. So installed capacity shall be 358 multiplied by 1200, which is 429,600. Now ratio of product BP is for 1 metric ton for product C, and for product BP shall be 1 metric ton. So there's a byproduct which is generated while generating the product C. Product C is the final product. Byproduct is generated, which is BP, which is generated in this particular business, in this particular factory. However, company can utilize, sale, dispose of only 1100 of byproduct per day. So byproduct which is utilized is only 1100 per day. So the total byproduct BP can be utilized shall be 1100 multiplied by 358. So although the plant capacity is 1200 into 358, but the byproduct which is being produced, which is the actual finished good, that can be prepared only up to the extent of 1100. So our installed capacity will be 1100 and not 1200. Again, limiting factor is the concept which is used over here. Limiting factor. Although the plant capacity is 1200 metric ton, okay, plant capacity is 1200 metric ton, but the finished goods capacity, one of the byproduct finished good capacity is only 1100 metric ton. So our entire plant's capacity, installed capacity will be 1100 and not 1200, because 1100 is the bottleneck, it is the limiting factor. Okay, okay sir. Now 393,800. During the year, company has produced 354420. So what is the capacity utilization? Capacity utilization will be, we'll divide 354420 by 393,800, which is the installed capacity. So this is the installed capacity in this particular case, using the limiting factor, which is 1100. 90% is the ratio. Okay sir, got it. So this is the explanation which is given, which I've already told you guys. So please read this this explanation also carefully. All right. Yes, one very interesting variant. So it is a continuation of illustration number 29. Illustration number 30 is continuation of illustration number 29. Okay, and illustration number 30 guys, please mention one line which is not written over here. Since it's a connection to illustration number 29, that's why we can just infer from that illustration number 29. One line is to be written, which is to be taken exactly as per illustration number 29. And what is that line? That line is that, 7 days of annual planned maintenance is happening in this particular company. So 7 days annual maintenance takes place. So in illustration number 30 also, 7 days annual maintenance takes place. That is given because it's in continuation with illustration number 29, and the answer is also created using this fact, which is missing, somewhere missing in this question. So you please add 7 days annual maintenance. Okay. Now the question gives you a computation. So April to September, 30 into 6 into 800. So in the first half of the year, the capacity was 800, and suddenly in the second half of the year, capacity has been increased to 1200. That is the increase in capacity, and of course pro rata capacity will be taken. The closing capacity will not be taken for the whole year. Pro rata capacity will be taken as we have taken in our earlier questions. So 800 from April to September, 1200 from October to March. 7 days of planned maintenance, and that planned maintenance happens in October to March. That is how that is what is given to us in this particular equation. It's just that, guys, just put one bracket in this equation so that your computation is correct. So 30 days in a particular month, 6 months, 30 multiplied by 60 minus 7 days. So 180 minus 7 days. 7 days of annual maintenance is reduced. Okay. So 180 days, 30 into 60, 180 days minus 7 days of annual maintenance reduced, multiply by 1150 is the actual capacity utilization that we have done. So 1150 is the actual capacity utilization. Okay, and installed capacity is given in this manner, which is incorrect. This is incorrect. Okay, 30 multiplied by 12, again put a bracket over here, minus 7 multiplied by 800, this is given. So you have to basically rectify this calculation. This is erroneous calculation, this is the wrong calculation. You have to rectify this particular calculation. Okay, sir, we'll rectify it. Now, first of all, we'll calculate the installed capacity. The installed capacity will be, for the first half of the year, 30 multiplied by 60 multiplied by 800, where her 800 was the installed capacity. For the second half, October to March, 300 multiplied by 6 minus 7 days. So 180 minus 7 days multiplied by full 1200 is the installed capacity. Full 1200 is the installed capacity. There is no limiting factor which is given in this particular question. So full 1200 is the installed capacity. So amount is given as this. So the installed capacity is 351600. This is the installed capacity. Now what is the actual production which happens over here? So actual production from April to September, it's 144,000 and 198,950, which is already given in the question, guys. 342,950. It's already given in the question. This is actually the actual production. We are taking it as it is. It was just that this installed capacity was wrongly computed by the question. Okay, so we have rectified the installed capacity. So the capacity utilization comes to this particular figure. That is how the question is required to be solved. Okay, sir, got it. So yes, fair bit of reasonable bit of quite interesting and intelligent questions that have been devised by the Institute of Cost Accountants of India to really improve the guesswork in the paper. Guesswork is now no more a guesswork. It's a fair bit of a hint that Institute is going to give the variants of the questions like this only. Okay, sir, got it. Let's move on. Next chapter is Management Reporting Issues and Analysis, and I've always told you that this chapter is absolutely a googly chapter. So you never know from which part of your costing syllabus, strategic cost management, what part of your SFM syllabus can a question come from this particular chapter. This chapter is a miscellaneous chapter. Anything and everything can be asked in this particular chapter. Maybe a concept of SFM can be asked in this particular chapter. Maybe a concept of costing can be asked in this particular chapter. So it's an open-ended chapter. No one can predict what can come from this particular chapter. It's just that you just practice questions which have come in past, practice questions which are there in the study mat, and practice questions which are there in the workbook. That's all what you can do. So let's see what are the questions which are given in the workbook. Illustration number 1. Negotiating job work through own manufactured cost sheet. Company A manufactures product X cost sheet of which is given below. Due to increase in demand, it wants to manufacture additional quantity through job work by third party. So company A is manufacturing product X. Due to additional demand, it wants to manufacture more of product X. Okay, and these are the various costs which are given to you in this particular cost sheet. Company wants to negotiate job work charges with help of this cost sheet. So what are the job work charges that can be negotiated with help of this cost sheet? Please advise how job work charges can be negotiated based on this cost sheet. So based on this cost sheet, what are the relevant elements which are involved for decision making, so that if we give this work, currently we are doing this work in-house in our own factory, we want to give this work to someone else. Now we want to negotiate with that someone else. So obviously guys, whatever cost we are incurring, we'll tell him that this is the cost that we are incurring. You please add a reasonable profit on your cost and give us a price, a good quotation, because we know what kind of costing is being incurred in doing this job work. Okay. So what we do is, out of this gamut of expenses, we'll pull out all those expenses which will be done by him, by that particular person, whatever expenses are being done by him, and then we are going to give him a quotation. So okay, electricity cost, stores and spares, factory overheads, insurance, depreciation, employee cost, administrative overhead and interest. Out of all the costs, these are the costs that will be incurred by that particular person. Job work charges that should be comparable to conversion cost of sale manufactured plus a reasonable profit, say 10%. We'll add a reasonable profit of 10% in the cost, and then we are going to ask him to give us a fair quotation on this particular basis. Okay. So, electricity charges are included. Okay, raw material consumption, the raw material is not included because it remains the same, either it is with him or him. Actually raw material will be supplied by you, by the supplier. Raw material will not be bought by that particular job worker. You will be supplying the raw material. Therefore, we have excluded the raw material cost. Raw material consumption will not be there in this job work. So we have excluded the raw material cost. Okay, so the cost which we have excluded, we'll ask him to give us a quotation without that cost. Again, another cost that we have excluded is packing material cost. Packing material cost we have excluded because he doesn't have to pack. He'll give us without packaging. We'll pack. Okay. So packaging cost is also reduced while giving the quotation. The third expense which is reduced is marketing expenses. Marketing expenses he will not incur. He will not incur marketing expenses. That we'll incur. So we reduce the marketing expenses also while giving the price to him, while asking him the quotation. So whatever expense he is not going to incur, we have reduced those expenses, and whatever expenses he is going to incur, we have just added those expenses, added a markup of 10% and asked him to give us the quotation. Okay, that is how the question is done. A very interesting question, a very simple, straightforward kind of a question, but since you have to cull out all those expenses that are not to be done by him, by the job worker, you might get confused. So please practice it well in your register. Please practice it well. Capacity utilization. Again, very similar to capacity determination. So capacity utilization, a question, company X is manufacturing product Y, which is presently being operated at 50% capacity. So 50% of installed capacity is to be done. Due to increase in its market demand, now the management is desired to operate it at 75% capacity. So we are increasing the capacity from 50% to 75%. Its cost structure at 50% capacity is given to you. This is the cost structure at 50% capacity. Raw material 77,000 per unit. Packing material 100 per unit. Packing material. Utilities are also to be consumed, which is 1 unit per unit of product Y. 2,000 per unit is the utilities which are being consumed. Okay, fixed cost is there. Now please consider that raw material cost, packing material cost, utility cost, these are variable cost. They will not change per unit. They will remain as it is per unit. Per unit cost will be same. However, these costs are going to be changed because per unit cost is different. These costs are going to be changed. Per unit cost is going to be changed. Okay. Following points may please be considered. Historical past data shows that at 75% cost, specific utility consumption shall be 0.9 unit per unit of product Y. Okay. Now over here, utility is also reducing on a per unit basis. So 0.9 from 1 unit per unit of output, we are going to 0.9 unit per unit of output. So per unit is also going to be decreased in case of variable cost. Okay. Next, discussion with charge of maintenance provides for 10% increase in the consumables and spares and repair and expenses. So these two will be increased by 10% when the capacity changes. When the capacity changes, these two will increase by 10%. Okay. And then management decided to consider 5% increase in overheads. Overheads is going to increase by 5%. overheads are going to be increased by 5%. Rest everything will remain the same. No change in anything else. Okay. So guys, that's it. We are going to just take these additions in our working, and we'll prepare our workings accordingly. So these are the workings that we have prepared. We have increased the utilities cost. Okay. Then fixed cost, we increase the consumables, repairs and overheads we have reduced. Everything other remain the same. That is how the computation is required to be revised. So simple question. Again, please get it done so that you are able to really be clear as to what is the concept. Okay, a very, very interesting question, a good question. Okay, in this particular question, maximum permissible cost of raw material is required to be ascertained. Following data are available from cost records of company X which manufactures product Y using raw material Z. Okay, so Z is the raw material and the finished good is product Y. This is the raw material and Y is the finished good. Z is the raw material and Y is the finished good. You have been given the selling price of Y. You have been given the desired margin when you sell the product Y. Content of raw material Z in product Y. So how much content is there of Z in product Y? 2.165536 metric ton per metric ton of Y. Okay, this is the raw material constituent of product Z. Conversion cost of product Y. Then other raw material other than Z, there are some other raw material which are being used. What are their share? Their share is 10,008 per metric ton. As a cost auditor, you are required to advise for maximum permissible cost. What will be the maximum cost of raw material Z that is to be, that can be purchased so that we maintain these numbers. So we'll do a reverse calculation. This question is of a reverse calculation. Selling price of product Y is 86,000 is the selling price of product Y. Then less the desired margin. Desired margin is 15% of the selling price. So 86,000 multiplied by 15%. This is the cost of product Y. This is the cost of final finished product Y. This is the finished good. This is the cost of production that is to be taken. Now we are going to reduce the conversion cost of product Y. Conversion cost is 2582. Where does it come from? Guys, this is the conversion cost. The labor which is involved and other overheads which are involved. This is the conversion cost 2582. Total raw material cost of product Y. This minus this is the raw material. This is the raw material which is involved. Okay, that is labor and other overheads. This is the raw material which is involved, 47220. This is the total raw material. Now this includes Z and other raw materials. Both is included in 47220. Now if we reduce the other raw material which is apart from Z, 10,008, then we are left with the price which we can afford for product raw material Z. Raw material Z can be purchased up to 37,221 per metric ton. This is the cost that we can afford for product Z. Now how much quantity of product Z can be purchased by this particular amount 37212? We are going to divide it by the input output ratio. 1 metric ton of product Y shall require 2.165536 metric ton of product Z. So the total cost of product Z will be divided by 2.165536 to get how much metric ton of product Z is really required. So 17183, this is the maximum permissible procurement cost of the raw material Z. This is at max whatever we can pay per metric ton of product Z to have a desired margin profit ratio and the desired numbers. This is the amount of cost that we are going to spend for Z. So yes, a little complicated calculation, but a very straightforward one, guys. A very simple one once you understand. So understand it well. It seems to be complicated, not that complicated. Please understand it well. Okay, you're a costing student, guys. Costing student means these small costing problems should be a cakewalk for all of you. These are not difficult at all for costing students. Yes, sir. Got it. All right. Illustration number 1, a theory question, a very, very simple theoretical question, which is actually not very difficult. Break-even point analysis. Yes, I've told you, under this chapter, anything and everything can be asked. So break-even analysis is asked, but a very simple break-even analysis, the contribution, calculation that we do in our costing, financial management. Selling price, variable cost, fixed cost is given. You are required to calculate the break-even point, and you are required to calculate the number of units to earn a profit of 6 crores per year. Reverse calculation. Very simple calculation, very straightforward calculation. So we're not going to delve into details of this calculation. Okay, sir. Then comes the variable cost, fixed cost. Again, theoretical question, but a straightforward theoretical question. Very easy question, guys. Theory, pure theory. You have to identify the fixed cost and the variable cost. That's it. Optimum product mix. What should be the optimum product mix? Again, a good question. Okay. Now we have two products which are there, which we can make. Company X is manufacturing two products, product A and product B. Both are manufacturing using the same plant and machinery. Both are manufactured using the same raw material. Okay. And A and B both can be produced at any time during the day. Process cycle time for both of them are 67 metric ton per day. So on per day, the product A can be produced for 67 metric ton per day, and product B can also be produced for 67 metric ton per day. Contribution of product A is 40,000 per metric ton and product B is 30,000 metric ton. So we'll give preference to product A. Product A contribution is higher, product B contribution is lesser. So we're going to give preference to product A. Yes. Market can absorb 14,000 metric ton each of product A and B. Now this is the limiting factor. Product A cannot be produced more than 14,000 metric ton. Market cannot absorb beyond that. Okay, so fixed cost per annum is 4,500 per lakhs. So what is the optimum product mix? You have to understand, you have to find out what is the optimum product mix for maximum profit. To attain maximum profit, how many kgs of product A and how many kgs of product B can be produced. Now first we talk about product A. We'll prefer that entire amount of product A will be produced. Entire 14,000 metric ton of product A can be produced. In one day, 67 metric ton can be produced. So 209 days, for 209 days, only product A should be produced. For 209 days, only product A should be produced. So 14,000 metric ton will be produced and contribution is 40,000. So total contribution is 5,600 from product A. Now for the remaining days, that is 355 minus 209. For the remaining days, which are 146 days, we can produce product B, right? So 146 multiplied by 67 per day. So 9782 is the total product, amount of product B which can be produced. Contribution 30,000. So profit is 2934.6 lakhs. So the product mix is given as under. Okay, sir, got it. So this is how the product mix is required to be ascertained. And yes, after reducing the fixed cost, we come at the profit. So all these calculations are pretty straightforward. Okay, sir, got it. Contribution and profitability analysis. Again, break-even point is required to be calculated. PV ratio is required to be calculated. Contribution is required to be calculated at the break-even point. Absolutely simple, straightforward calculations as we have done in our costing syllabus. So I'm not going into details of these calculations, guys. Okay, sir. Internal benchmarking. Yes, again a theoretical question, and benchmarking we have studied in our BVM SPM concept also. BVM SPM also has benchmarking, and similar kind of a question is also given in our cost audit. Again, a theoretical question that you just need to read through and understand how benchmarking is to be done. Benchmarking means that when you are comparing your current year results with previous year results, or you are comparing your current year company A result with current year company B result. You are benchmarking your standard that I have to get there, and then you are comparing your results and finding out the output. So in this particular question, product A and product B cost is given to you with a comparison in terms of percentages, and then you have to comment on please advise the company which areas should company focus on in case of benchmarking. So obviously all these areas have to be focused on, like raw material is to be compared, what consumption of raw material is happening, why is price increasing 42504600. So all these are benchmarking areas that we need to see, and this is how the answer is required to be written. A pure theoretical answer, this is how the answer is required to be written. Okay. Okay, sir, got it. Very, very interesting question. Illustration number 10, short question, but a good question. If a filler question is required to be given by the examiner, filler question means that, question which has only 4 marks and fills my 100 marks of paper, then this question can be given. A company gets product A manufactured on job work basis from job worker B. 10,000 metric ton per year are manufactured at 6,000 per metric ton. Job work charges which are paid are 10% of total cost. These are the job work charges. Okay, these are the job work charges. These are 10% of the total cost. So what is the total cost? Total cost of production is 60,000 per metric ton. Okay. Please understand this. Job work charges which are paid are 6,000 per metric ton. Company G gets product A manufactured on job work basis. So on job work basis, the production happens, the 1,000 are manufactured at 6,000 per metric ton. And this is only 10% of the total cost. Okay, so what is the total cost? Total cost is 60,000 per metric ton. So total cost is 60,000 per metric ton. Okay. Now, due to increase in demand, company wants to have another 2,000 made through another job worker. So another job worker will make 2,000 metric ton. It is not possible for the job worker B to sell their additional capacity. Therefore, some other job worker is required to be find out, right? And that job worker, who's new job worker, he is charging 6,250 per metric ton. The old job worker was charging 6,000 metric ton, and the new job worker is charging 6,250 per metric ton. So there's an increase in the cost. There's an increase in the cost. Okay. Then says, should the company accept this quotation and go for additional 2,000 metric ton? Should the company accept this increase of 250 rupees per metric ton? Okay. To compute the answer, we're just going to compare the new cost. Okay. Now, the new cost of job work is 6,250, which is charged by the job worker. Okay. And now this time the total cost will be 6,0250. Where does this come from? The original cost plus 250 additional cost, which has been incurred by the current job worker. So 6,250 divided by 6,0250. The 10% ratio is now distorted. 10% ratio is no more applicable. Then what is the increased ratio? Increased ratio is 6,250 divided by 6,0250. So now the job worker cost is 10.37%. Now the total cost of job worker versus the total cost of the entire product is 10.37%. So effectively, we are increasing our cost by 0.37%. By 0.37%, the cost is getting increased in the current year due to the work being given to some other job worker. Now guys, very, very important. Our demand is increasing because we are having additional supplies, additional orders. So our demand is increasing. When our demand is increasing, then this small increase of 0.37% doesn't matter at all. So even when there is a small increase of 0.37%, we should accept the order. We should accept the job work charges of increase of 250 rupees. That's the conclusion that we are going to draw. Okay. So the charges are 6,250 divided by 6,0250, 10.37% is the revised cost, and we should accept this cost. We should accept the increased cost because additional 2,000 is the demand that is being created for us. But yes, you should read this entire conclusion very, very carefully. All right. Beyond this point, guys, there are only MCQs and very straightforward MCQs. I have nothing to discuss in these MCQs. These are simple MCQs which are there in your workbook. Again, this seems practical, but it's not practical. It's all theoretical. Okay. Very theoretical provisions, which are straightforward provisions like CSR provisions are there in these MCQs. You read it once, you'll be able to understand it absolutely completely. And if not, I'm always there. Main hoon na. In the comment section, you can comment, or you can give me a call on my query number. Drop in a WhatsApp on my query number. Okay. So that's all. These are the MCQs which are given, which are very straightforward. I've already told you. So yes, guys, that's all for this particular workbook, which has been introduced by the Institute of Cost Accountants of India. And yes, it's important. Its importance is non-negotiable. You have to do this workbook threadbare before your examination. Please solve all the questions from this workbook. They might come in your examination. So yes, on that positive note, let's hope and pray that many questions come from this workbook. Many questions as it is are flowing from this workbook, and we get good marks in our cost and management audit. And as I've already told you, 80 plus is cakewalk in cost and management audit. Let's hope and pray that all of us get 80 plus in cost and management audit, and my ears are eager to hear, so yes, I got 80 plus in cost and management audit, and yes, I am a CMA. If you're going to become a CMA in this particular attempt, in the next attempt, comment in the comment section below, yes, I am a CMA, and let the magic of manifestation bring all your desires, all your hopes, all your dreams towards you as soon as possible. On that positive note, all the very best and happy studying.